Good morning, everybody. Wherever you may be around the world, it is 9 a.m. and that means it's time to game plan. And that's what we're going to do today, guys. Welcome aboard to the game plan. My name is Gareth Soloway from verifiedinvesting.com. Go check it out when you have a second. All right, we're going to get right into the mix here because we have lots to go over. All right, we're going to talk about some economic news, but before we do that, I want to go over some trade levels. Let's talk some trade levels right off the bat. Take a look at the chart right here. This is PayPal reporting earnings yesterday after the bell. Take a look at the dump in the after hours, where it's trading now at 66.84. All right, now the kicker is this, right? So we know that we have this type of movement here, and I want to show you exactly where the day trading levels are, where the technical support is. All right, so if we go to this chart on the daily, you can see again, this is where current price is. This is where it closed yesterday. Now, right off the bat, in terms of a trading level, there's a level right down here at around $63 a share. Now, where am I getting that level from? Let's talk a little bit about that. Let's zoom in here. All right, see this pivot top right here, and how it coordinates right with that low pivot, pivot to pivot. That gives you a level where right here, that's going to be a technical support level. Let's throw a trend line in there right now so we mark that level off. Now, if it breaks that level, and by the way, there's always a chance that it can break that level. You know where your next pivot point is? Your double bottom right down here, and that again is at a price point of $59.50 approximately. So right off the bat, you have your two levels on PayPal. This first one, to me, is not a swing trade level, to be honest. This second one could be. Now, I say could be because anytime you're thinking about swinging a stock, and this is great education, guys, you want to go to the bigger time frame. So right now, yes, I think this level around 59.50 could be a good swing trade, but what do we want to do? We want to look for a secondary factor. We want to go to a bigger time frame. Now, what's amazing about this is we can see if we zoom out on the chart of PayPal, it's had such a decline. All right, now, interestingly enough, I want to show you this because this is a big deal. If we zoom in, we can see that this wide range bar, look at how price rallied, but it never got above. Here's the high of that candle, and that's where we were. Now we're coming back down. This is called an inside bar, and anytime you get a wide range candle, there's always going to be a massive amount of selling right here and right in here. Now let me explain why there's a massive amount of sellers right up here. Because when you were down in this range, look at all the exchange of shares. People were selling and people were buying. An equal number of buyers and sellers were exchanging shares, which is why price stayed in a very tight range. Now what happened here is you had a dump out. All the people that bought here were like, holy crap, we just got smoked. And slowly, they've seen their money come back. The general psychology, and this is key, guys, understanding the human mind. The general psychology is that when you get back to break even, there's a large percentage, not everyone, some people swing for the fences, but a large percentage of people that will say, you know what, I'm back to break even, cut it, be done with it. All right, so that's the psychology why this type of action, there's so much selling here. And by the way, that's very similar to why I stated and have been correct that Bitcoin would see massive resistance at the $30,000 to $31,000 level, right? So if we go to the Bitcoin chart, which is where we are now, and I zoom out, and let me flip over here. Here's your Bitcoin. I'm even going to go to the weekly here so we can see it a little bit better. But that's why this level here is such a major resistance, because you had all these people buying in here. They were in the money. They didn't get out. They watched it come back. And by the way, up here, when we were at 69,000, think about it. What was the mentality? I saw posts galore. Oh, by the end of November, this was October, by the way, when it made the high, we're going to go to 100,000 and then 250 and so forth. So everyone was so bullish. The bottom fell out, hit here, broke. Now you have all these people exiting and saying, oh, well, now I'm back to break even. I'm going to take my money off the table. It's a very normal psychological thing. Okay, what I want to do is I want to jump over to this screen over here, guys. So let's take a look at this chart. This is Qualcomm. This is another stock that is getting hammered on earnings. The stock is down. We closed yesterday at approximately $129. We're down now at $116.52. This is a big company. By the way, Taiwan Semiconductor. So Qualcomm is a semiconductor company. And Taiwan Semi just about 2 weeks ago reported earnings and said, holy cow, the chips for AI are moving. We're able to sell those, but chips for phones and chips for computers are not moving. Well, guess what Qualcomm does? Chips for phones and computers. So is it a surprise we're seeing a dump? Probably not, at least not in general. Now, if we flip over here, we can look and say, okay, well, where's our technical support? And this is real easy to spot. You can see very clearly there's a level right down here. There's a gap fill and kind of gap window from here and right across here. So what I'm going to do is I'm going to put a trend line right through here, okay? And if we look here, right, so you can see very clearly, pivot low right through here, right through here, right through that low, and right through that low. So today's technical support is going to be at around 113, give or take. And again, we're at 116 right now, so you could hit that on the first flush out of the gates. Now, if we continue down, your next level is going to be right here at the gap fill at 110. And if you continue down past that, that's where things can get very messy, and you could even retest this low pivot, which is very close to 100. I would say the first level is a day tradable level. Second one is probably day tradable as well. If you get down to the third one, the 100 even number, you have the even number. We, as I said, want to go to the larger time frame, so let's take a look at that. I have some old levels here on the chart as well from a long way back. But again, we can even extend them out and say, okay, well, is there a level in this range? And if we do that, let me do that now. Yeah, I mean, you're getting into this area right here, right? So if we look back, and I apologize, I've got to find more room here, but there's a level right here across, which is below 100 at around 95 or so. So I would say 100 to 95, anywhere in that range starts to get interesting as a swing trade. And again, remember, what's a day trade? A day trade, you get in and you get out intraday. Swing trades you hold for days, weeks, you can even hold it for months. The difference between a swing trade and a long-term investment is defined by something that is a long-term capital gain, which means you have to hold it over 12 months. Anything less than 12 months you could say is a swing trade, but in general, swing traders are holding for a few weeks to a couple months. All right, so let's go over a few other things. Flipping back here to this here point, I want you guys to understand a couple big events that occurred overnight. Number one, Japan did another bond buying program. Now, what's so mind-blowing about this, and we've just come after the debt downgrade by Fitch, where the U.S. debt got downgraded, but we know from last week that Japan basically was saying, hey, listen, inflation is so high, we can't artificially keep rates at essentially zero. We need to let them float up. The problem is this. Check this out. When they started to loosen control of the yield curve, yields began to spike too aggressively. And again, this is what happens, is governments try to control this crap, and when they loosen up, it begins to spike back to where it's intended to be, where market factors are showcasing that it should be. And what we're seeing in Japan is that they have so much debt to GDP, they have so much debt, all these issues plus inflation, is that yields in Japan should be much, much higher. And so to keep yields from spiking too much and just raising them a little bit, Japan is having to do bond buying. And remember, bond buying is essentially flooding the market with money. And this is going back to what the Fed will eventually have to do. The Fed will eventually have to do this as well. They're going to eventually have to print money. Now, Japan's not going back to print unlimited money. They're just trying to control the yield curve. And it's literally like playing with a lit bomb right now. I mean, like if they don't do it right, you can have a blow up, which by the way, the market's starting to tell us. If we look at the VIX spiked yesterday. We know the market sold off, right? There's a debt bomb, and I've said this for a long time, is when you have countries that have debt to GDP where they are, like the US and Japan and much of Europe, this is problematic. This can't go on forever. And when you have inflation, that's when you have trouble. When there's no inflation, you can do it. You can print unlimited. I mean, think about MMG, modern monetary theory, MMT. The idea here was that governments can print unlimited amounts of money. This was somehow believed by economists over the last 10 years, as well as a lot of politicians. And politicians are idiots, frankly, most of them at least. So that's not even a big deal. But the economists, that was always surprising to me. Because how do you think that a government can just print unlimited and there's no repercussions ever? There is. If there's a repercussion for my household, the US or Japan or all of these countries, they are just a bigger household with more individuals under one roof. Okay, so that's one of the keys here, guys. By the way, the big thought process, and I've said this, you kind of have to crack up sometimes because, people kind of say, oh, you're crazy, inflation's coming back and sub 2% and the Fed will be able to do this. And I'm like, no, inflation's going to stick around 3%. it's going to get sticky at 3%. And now all of a sudden, Bill Ackman did a tweet last night, one of the big hedge fund managers in the world, by the way, saying that he's buying or he's basically shorting long-term bonds because he expects long-term rates to spike dramatically higher. In fact, let's take a look at the 10-year right now. And the concept here is that the short end is much, much higher, right? So the short end, if we look over here, let's go to the 10-year, the short end yields, the short end interest rates are much, much higher than the long end. And the idea is everyone expected inflation to be high in the short end, which is why interest rates were high in the short end, but to come down later. Well, guess what? Reality is that's not happening, which means the yield on the 30-year, on the 20-year, even on the 10-year is likely going to go up. All right, so again, by the way, the charts told us this, and this is what's amazing about the charts. Even I was kind of like, wait a minute, maybe yields will start to fall. Maybe we'll start to see, the economy weaken and inflation come down more than expected. And then I looked at this chart, and this chart is as clear as day. And when I saw it, I said, no, yields are going to go higher because you have a very clear trend line, and you have a pullback, hit, pullback, consolidation in a bull flag, breakout, and then a retrace to the scene of the crime. And 9 out of 10 times that happens, when you retrace to the previous resistance, which is now support, you get a breakout. And look at the 10-year, 4.18. Now, the scary thing about this, folks, is that the last time yields popped, if we go back on the 10-year, right, see this high where you had this big pop? You know what happened there? Silicon Valley Bank failed. All these banks failed. So you get credit issues, you get credit crises from big spikes in yields. And we're probably approaching that. Look at this breakout here. Again, the reason why I say this is a breakout is because it's a short-term breakout. If I put a trend line at this high, that was that high. Now we're breaking out. Next target is this point right here, which is the highest point, which, by the way, you want to know something crazy? By the way, this was when yields topped out. It was October of 2022. That's when the stock market bottomed out. So in theory, it tells you how offsides the stock market is and how much risk there is, that in theory, if the 10-year goes back to this point, why isn't the stock market back to October lows, which is down, what, 20, 25% from where we are? Just saying. Now, listen, there are some differences, right? I mean, you could argue that inflation isn't as high as 9%. That's true. But again, if we see any sign of, and this is the kicker, any sign of a slowing economy, meaning a potential recession. If that happens, and by the way, jobs numbers have remained strong. ADP yesterday was strong. Jobless claims today stayed low. Everything's looking okay. Jobs report tomorrow is going to be key. But if we see a recession on the horizon and you still have inflation at 3%, watch out, because the markets will react and flush. And by the way, just going back to the 10-year yield spiking, one of the big issues here, guys, is not only that the U.S. has 32.5 trillion in debt, 1 trillion essentially in interest payments, but a lot of companies have debt that's now rolling over, and they're going to be essentially refinancing or redoing that debt at current levels versus 1% what it was. We're now looking at 5-6% type renewal of corporate debt. And that, again, is going to be a huge drain on earnings over the next few years, because there's a huge difference when you have $10 billion in debt, which so many companies do. If you're paying 1% on that debt on a yearly basis or 5 or 6%, think about that. For those of you that have bought a house recently, think about the difference between what you would have paid at a 3% mortgage. Now you're paying 7 to 8%. Huge, huge monthly different payment. So again, storm clouds, and again, flipping back here, guys, storm clouds continue to brew. I've been warning about this. I'm not going to say that this is the beginning of the collapse. I'm not going to say that this is the exact high. We'll find out. What I am telling you is that over the next 6-12 months, things are going to get tricky. And as long as you've been following me, you know that I've been warning about this. And I want you guys, even if you say, screw Gareth, forget it, I'm going to go long the markets, I'm going to go long every big tech stock out there, that's fine. I just want you to have a balanced picture, because this morning when I turned on CNBC, and again, you guys know my point of this show is to not be mainstream media and not feed you guys the same crap that they're seeing. What did I hear? Oh, Warren Buffett said, don't worry about the downgrade. Jamie Dimon said, don't worry about the downgrade. No big deal. Don't worry about it. Okay, well, why? Well, let's look at the data. What's the data showing? And the data is showing a insanely different picture. Now, why would Jamie Dimon and why would Warren Buffett say don't worry about it? Well, they don't. Imagine if Warren Buffett came out and said, "Holy crap, we're screwed." I mean, think about the collapse that you'd see. So and not only that, but they have investments. The bank, I mean, JP Morgan has a ton of commercial real estate that's probably worth almost zero. If they cause panic, what happens to the banks? What happens to JP Morgan? I mean, you have to look at the underbelly of why they would be sowing the seed of relaxation and no big deal. It's not as simple as like, oh, they truly believe that. It's more like there's these other factors that are making them say that. So just understand that. And by the way, it's not to say that the reduction in debt rating of the U.S. it's not a huge deal, but it's the beginning, in my opinion, of something that, again, should have been done a long time ago. The U.S., with as much debt as it has, should not be a AAA rated country. All right, a couple other things here, guys. Jobs report tomorrow on Friday, so that's a big deal. I'm expecting between 100 and 200,000 jobs created. The ADP number was over 300,000, so it does show continued strength. Anything that's over 100,000 will probably be viewed as reasonably strong. Anything over 200,000 will be a risk of the Fed continuing to hike. Today we got some data here. If we flip over here, all right, so we got some data this morning. We got jobless claims coming out, and I don't know if we'll see here. I'm looking through this, but anyways, the point is, and again, I'm not seeing it right off the bat, but we did get some data out. Jobless claims today, guys, coming out at, I think, 227,000, which was right at consensus estimates. And basically what we do know about it is that continues to show that the jobs market in the U.S. is still pretty strong. ADP private sector yesterday, very strong as well. So the jobs number should be strong. The key is, what is consumer CPI? What is the CPI data next? I think it's next. I'm not sure if it's next week or the following week, but that is going to be the key. I think it's next week. CPI data with oil and gas. And let's do a quick check-in on oil and gas here. Let's flip over here as we look at U.S. oil. Okay, so if we look at the daily chart of oil, oil had a pullback yesterday because of the market freakout. It's starting to bounce back today. Either way, for the month of July, there was a big gain. There's no denying it. No one can tell you that this is not going to impact month-over-month CPI. If we look at gasoline, I generally expect the same sort of thing here. And if we flip that chart up, gasoline's actually coming down. So yesterday had a big drop. Today, a little drop, was down further, now coming back just a little bit. All right. Let's go over gold here quickly, and I want to go over silver as well. So if we look at gold, gold continues to inch a little bit lower. On the daily chart, we do have some levels to watch here, so let's take a look. Right now, we are at short-term support. Let me put my trend lines in so we can all follow them along with them. I've been a strong proponent of gold, as you guys know. And again, if we flip over here, what we can see is gold, again, pivot to pivot. Remember, retrace to the scene of the crime on the yield. On the 10-year yield, well, guess what? Pop, pull back right to the scene of the crime. Now we're coming back in. There's a little level right in here that I'm watching very closely today. It's right around this $1,930 level. I want to see if we hold that. If not, we might actually retest again the scene of the crime. That's not the end of the world, but in general, scene of the crimes, the best scenarios are one hits. So we would rather, as a technician, if you're bullish on gold, you'd rather it not come back to this line. Doesn't make it not bullish anymore, it just makes it slightly less bullish. So a retrace to the scene of the crime and a go, that's generally your highest probability scenario. If it retraces, it lowers the probabilities ever so slightly. All right, let's go to the silver chart here. All right, let's go to the silver chart. And again, silver is continuing to come down. I have a key trend line I'm watching where I'm considering buying a long position on silver. Take a look at this trend line here. So if price, you notice the trend line, if price comes down to this level around 22-ish, that is a buying level on silver. And by the way, folks, on kitco.com, I'm launching metals on the move. It's going to be research, charting, support, resistance, all the good stuff on kitco.com. Probably next week it will launch, so charts will go there for commodities. It's going to be free. So again, you'll be able to get in access there. And again, it is the precursor to a specific commodity service that eventually I will be launching. But again, all free at Kitco, all the information, check that out. All right, next up, let's take a look at the two big numbers from today, guys. We got to look at Amazon before I step off here. Amazon chart. Here's your weekly Amazon chart. Now, the first thing that I see, I want to show you guys some charting, And this is, I love doing this, right? Because it shows you guys what you can do. All right, so you wonder why Amazon bottomed where it did on this chart. Look at that trend line right down. All right, so now, right now, that doesn't help us determine whether or not there's a top. But I will say this, is that on the chart, this is the short-term resistance we're at. So Amazon, again, 136 to 138. This little low pivot to that area right here is a little bit of resistance. Now, I personally don't have an amazing read on whether Amazon will go up or down. What I do know is that a majority of companies, even if they're beating earnings, are falling on earnings. Now, I'm not going to go short Amazon. I don't do that type of thing, not unless there's an amazing amount of indicators that tell me a move is going to come on earnings. But I will say that, again, you have a move up. Usually, again, tops are made. You hit support, you have a retrace. Much like the NASDAQ chart here, and I think it's important to recognize this. Man, I have so much to go over, but I can always go over more tomorrow, is if we look at this chart, very similar. Down and then a retrace. So again, are we going to curl over or are we going to hit the all-time highs on the chart? All right, next up, Apple reports earnings after the bell. Apple has gone into the stratosphere. A really amazing move here. It has started to pull back. The one thing I noted recently is that on the weekly chart, let me show you guys this. The weekly chart put in a topping tail. That candle right there is a topping tail. Topping tails are bearish reversal signals when they're at highs of charts. This is obviously an all-time high, so it's obviously the high of a chart. But look at how we haven't negated that and we're going into earnings. Of course, there's no easy ticket here. Apple could just as easily rally on earnings, but I will say this, as long as that topping tail's intact, probabilities, and probabilities are what I trade off of. Probabilities are a drop. That is what a topping tail tells you. Doesn't mean it's 100% right all the time. I want you to understand that. All right, it basically tells you 70% of the time when you get this, you have a downside move. Still 30% it could fail. That's probabilities for you. All right, guys, it's been fun. I got to get going. Don't forget Metals on the Move on Kitco. I'm doing this show every day, including tomorrow. Tomorrow's Friday, and we're going to have the jobs report to go over. We're going to have, obviously, the earnings of Apple and Amazon. So stay tuned. Come back tomorrow, 9 a.m. Thank you so much for watching, folks. I really, really appreciate it. And again, have a great rest of your trading day. Talk to you soon.